Well, Howard, it's almost lunchtime, you know,
By your standards.
here. So, one, I want to thank you for coming. And I want to talk for a moment about something that plays an important element in cycles, and you've spent a lot of time writing about it. And before I get there, one of the great challenges for all of us to contemplate today is this area of trying to understand finance and financial markets. And many of you work in that area, and I want to challenge each of you today, because this is an area Howard and I, we might touch on it, have focused on together for more than 4 decades. And that challenge is, what do people think? What is their view? There's a quote in this book that Howard gives you from John Kenneth Galbraith talking about how little finance or access to capital or financial markets as you know it, how little it plays as people talk about history and what occurred in history. You know, over the years, and there it comes. Why don't you tell us about that to start, Howard?
Well, first of all, it's from a book called The Brief History of Financial Euphoria, which I read a very long time ago, which I recommend to everyone. It gives you a good feeling for cyclicality, for the behavior of the herd, for the importance of contrarianism. And it is an honest book in the sense that it is brief, and I enjoy that. But the point is that in investing in particular, one of the outstanding characteristics is shortness of memory. And the point is, we know so much from history, but if we disregard history, we know so little. If we disregard history, then every time something happens anew, we have to start from scratch figuring out what it means. If we understand history, we can put it in we can do what I call in the book pattern recognition. And we can say, oh yeah, that's like that. I saw that 10 years ago and 30 years ago, and here's what it comes from, and here's what plays out, and here's what it's going to result in. But most people ignore history. Most booms, and I've probably lived through about a half a dozen real booms in my 50 years in the business, are usually about something new. And the internet in 99, the Nifty 50, Xerox in 69, whatever it might be, subprime mortgage securities. And the people who get excited about it, who cotton to it, who are intoxicated by the positives and willing to ignore the negatives, if you say to them, well, that happened 20 and 40 years ago and it ended badly, what they say is they use the 4 worst words in the world. It's different this time. The rules of the past don't apply. Yes, the average PE ratio historically has been 16, but now it's 32, and that's okay because the internet has changed the world, and something like that. And so, go back one slide though, if you will. And what it says is that past experience, to the extent that it is part of memory at all, is dismissed as the primitive refuge of those who do not have the insight to appreciate the wonders of the present. And if you say to somebody in 99 who's buying an internet stock which has no profits and no sales and at an astronomical price, they say, well, you just don't get it. You're an old fogey. And the point is that the past is relevant, and now you can bring up that next slide, Michael, because that was a good one. Thank you. And most of the time it's not different. Now, clearly, some of the time it is different, but not as often as people think.
Let's talk for a moment about this slide by Reinhardt. And there was a book written this time, it's different, and it really related to sovereign debt and credit. And so I'm at Berkeley in 65 studying credit, and almost all sovereign debt is rated AAA. and it's considered the least risky debt of all. And the head of the Federal Reserve, Paul Volcker, in the 70s, is telling everyone that no country ever defaulted, ever went bankrupt. Yet it has absolutely nothing to do with history. And I think I want to just underline this point that Howard has made here. When you step back in history, ask yourself, have you done the original research? What is common wisdom? You know, as I listened to Paul Volcker in that period of time, Chairman Volcker, talk, and the speech I remember most, Howard, was one in around 80 or 81, that Poland is not International Harvester. Both Poland and International Harvester were trading at 31 cents on the dollar. And his point was, Poland is a country, countries don't default, or don't go bankrupt. And of course, International Harvester could go bankrupt. Well, he was right, but he was wrong. International Harvester paid you off 100 cents on the dollar, never missed an interest payment, and Poland reorganized its debt in the 30s. So for every dollar of debt, you got 30 cents of
Well,
something.
he was right semantically, he was just not right financially, right? Yeah.
And so I just want to stress the importance of research. And Howard, let's go back to the late 1960s, early 1970s. And when I went to Wall Street, we had fixed commissions for stock. And the highest compensated people in the financial system were those that were generally equity salesmen. Because when you bought a stock, the charge was 1%. If you bought $1 million worth of stock, you had to pay $10,000. Today, that might be $3.75 if you can't negotiate a better deal. And so they lived during this period of time, but when you went there, here's a look if you wanted to just buy 5 shares of Berkshire Hathaway. And Warren Buffett, who's a good friend of Howard and a good friend of mine, if you wanted to buy a stock, you can see what you would have paid then and what you've put to pay now. So being in that business, it's been a tough business to be in once you went into an open market. But the issue is, if you step back in that point in time, the fundamental issue was sales. And if you look at the pyramid on Wall Street, as Howard and I entered this period of time, almost 50 years, the power was in sales. Then it went to trading. And if you were long it overnight, you did a little research to try to figure out what is this thing. And so what my focus was, and Howard being one of the most representative individuals of this dramatic change that occurred, was changing this pyramid. Let's start with research. The fundamental part of investing is research. Have you done the data? So if you've come here today, have you checked off anything in the book? What these little post-its that you might want to relate to. And then we can go to trading. Can you actually buy it? It might be an interesting idea, but can you invest? And in the case of Howard, buying $1 million of something is not going to affect your portfolios or your clients. So the question in trading, is there a big enough market for you to deploy capital? And lastly, now you're focused on buying and selling process, but the inverting. Howard, take us back in your own career for a while and talk about why you chose to go to Wall Street, how you ended up at Citibank when we met each other.
Well, you know, I started off, my dad was an accountant, and I thought I'd become an accountant. I actually took accounting in high school and liked it. And I didn't admit that when I was in high school. But so I went to Wharton, and I figured I'd take a degree in accounting. But then when I got there, I started to study finance, and I found it more interesting, so I shifted over. Then I went to University of Chicago for a master's degree, and that was in accounting. And when I got out of there, I still didn't know what I wanted to do, and applied for 6 different jobs in 6 different aspects of finance. But I had a good summer at Citibank the year before. I liked the people, I liked what I did, so I went into investment research, and it was nothing more, wasn't a much more conscious decision than that. And that was 1969. Started off in equity research, and then became director of research. And the bank engaged in what was called Nifty 50 investing. It invested in the best and fastest growing companies in America without regard to price, because the official dictum was if it's good enough and fast growing enough, it's worth any price, which is kind of the opposite of what I think you believe, Michael. And if you bought the Nifty 50 the day I got there in 68, and if you hold it diligently until 73, you lost almost all your money in the best companies in America. And there's a lesson in that, of course, that it's not what you buy, it's what you pay for. But then in 78, because that exercise with which I was associated was so unsuccessful, it was time for me to find a new job. I was lucky I didn't get canned, and I switched to the bond department in order to manage money. And then in August of 78, I got a call from the head of the bond department. And he said, there's some guy named Milken or something out in California, and he deals in these things called high yield bonds. And can you figure out what that means? Now, you know, we take it for granted today. We all know what they mean. And actually, high yield bonds are quite mainstream today. But in those days, they were an obscure corner that very few people knew about. They were called junk bonds. And so I set about trying to study them. I met with Mike in November of 78, and then came out here to California to visit with him in January 79 for the first time. And now I'm investing in the worst companies in America, and I'm making money steadily and safely. And there's a really important lesson in that in good investing is not a matter of buying good things, but buying things well.
Howard, I want to maybe paraphrase what you've said. I'm not sure you're investing in the worst companies in America. What you're investing in,
well, I use that as a figure of speech.
Many great companies that have the wrong capital structure.
Right.
Okay, and so once again, as we focus on this, I want to take us back to the beginning and what's the focus for you, your children, your grandchildren. In a recent poll in the United States of people under 30, they asked the people under 30, will you have a better life than your parents had? And so maybe we could just, pull up that slide here for a moment and have you reflect on what percent of people under 30 in America thought that they would have a better life than their parents.
At what date?
In the last few months. Okay, so you've picked we're not going to embarrass you here, but if we look at the answer, you'll see it's a very low percentage. And if you go to Western Europe, you'll see a very low percentage. There is no country over 30%. But as you travel the world, if you're in China, it's 78%. And in Brazil, in spite of everything that's occurred, and Turkey is more than 50% higher than the United States, as is India and other countries. And if you go to Mexico today, that number is probably in the 80s. And so the question is, why do people feel that way? How do they feel? 90% are optimistic of the future in Mexico. And so they have a much different view of the world. And so one of the challenges for finance, and we're going to talk about it today, as we talk about these cycles, is that why do 50% of people under 30 think socialism might be a good idea? They obviously haven't been studying what's occurred in Venezuela as you've destroyed an entire country, the country with the most reserves. And you say to yourself, well, why do people feel this way? Well, the average person in America, what is its interaction with the financial system? One, a student loan, and the burden of student loan, that's now approaching $1.5 trillion. That is confining them as they think about their life. And second, a mortgage, whether they or their parents, and during this period of time, which we will talk about, they almost lost their home or they lost their home. So what is the financial system doing for them and this connection? But let's go back to accounting, Howard. In many ways, accounting is a language. Understanding a balance sheet, reading those footnotes, etc. But you outline in the book a few things that you felt were fundamentally required to be an investor or understand cycles. Accounting was one, but why don't we talk about a few of those?
Well, I think everybody knows you have to understand accounting, you have to know finance, you should know something about history, but the most important thing, which they don't teach you in business school, is psychology. And if you go back and look at the past, if you look at a graph of the economy for the last 50 years, it kind of looks like this. It's got an upward trend and very modest divergence from the trend. Sometimes the trend is a 2% trend line. Sometimes it's up 3 and sometimes 1. In extremes, it's up 4 or down 1 or 2. Very modest volatility. If you look at company results, companies have leverage, financial and operating, and their profits go like this. If the economy is up 2%, profits go up 10. If the economy is up 20%, profits go up 30, and so forth. And so if the economy is down 2, then for a typical company, maybe profits will be down 15. So the graph of profits is much more volatile than the graph of the economy. And then if you look at a graph of the stock market, it looks like this. Why? What's the difference? And the difference is psychology. And Richard Feynman, the great physicist, said that physics would be much harder if electrons had feelings. We walk in the room, we turn on the light switch, the lights go on every time. We don't even wonder about it. I wonder if they're going to go on this time. But that's because the electrons go in this pattern. They never go there. They never say, no, we're on strike. They never forget to move. They always do what they're supposed to do. But people have feelings, and people rarely do what they're supposed to do, and they often react in the extreme to the events that develop, and those extreme reactions cause this extreme volatility. They overreact to things, and sometimes they don't react at all, and sometimes they don't react as they should. So I think that if you want to exist in the investment world, and you want to, you can just buy and hold good things if you want to take that approach. But if you want to improve upon that, I think it's very important to understand the ebb and flow of psychology and act accordingly.